Welcome everyone to part 3 of the video cast. Want to welcome everyone to the part 3 of the video cast for investments. This is going to be a continuation of what we've been doing. We're going to do two things on this one. We're going to sell part of the investment off, and we're also going to purchase some between interest dates to show you how that's recorded. This first part is going to be a continuation of what we had. On the discount, we had $150,000, 8% stated rate, 10 years, 9% paid semi-annually was the market rate. Okay, this is the calculations for that. We've already done that one. But we're going to come down here, and I need this chart. We're going to assume the company sold $50,000 of the bonds on February 1st of 2016 for $49,000. So what we want to look at is this line right here, because this is an important line. That's the last one that we did as for the amortization. So we did up to here. We haven't done this one yet. Okay. First thing we need to do is find out, what did we sell? What was the carrying value of the bonds that we sold? Remember, we sold 50,000 of them. So that was 1/3 times the 140,880.03. Because we use this number here is because that's the last that we've amortized, and that's what we want to use. So equal. With these kind of numbers, I want a round function. 1/3 times 140, 2. So that's the carrying value as of December 31st. Now the problem with that is we need to bring it up to date. So we use 1/6 times. Okay, this is what it would be for the next 6 months. So that's why I use 1/6. I only want 1 month of the 6. The 339.60. But we want to take that times 1/3 is because that's the amount that we actually sold. So equal, round, 1/6 times the 339.60 times 1/3. Or you can divide by 3 if you wanted to. And then 2. So it's $18.87. We add those together, and that gives us our carrying value of the bonds that we sold, the $50,000 worth. Okay, investment. This is for the interest, the amortization that we to bring it up to date on that 50,000. Okay. Now I know we had the cash amount, but it's more than 49,000. We also have to include the interest earned. So let's calculate the interest earned first. So equal, round, and we know that it's, let me do it this way. I could take 50,000 divided by 3, or I just type in 50,000 times the 8% divided by 12, 2, or $333.33. And we know this amount here is what we just calculated there. Okay, so that's 46,978.88, because that's what that's for. That's the discount. That's what we got rid of, plus the interest earned. So the cash we received is the 49,000 plus the $333.33. So this gives us a gain. This will be gain or loss either way. So we'll take this number minus the 46,000 minus the 333, or we had a gain of $2,021.12. Okay, this is selling between interest dates. Now, I know that your textbook isn't as complicated. It didn't sell part of it off, it sold all the bonds. So you wouldn't have to worry about if you sell all of them, you don't have to worry about the fractions 1/3. You still do the 1/6, but not the 1/3. Okay, so that is selling bonds, selling part of the bonds off. Now, purchasing bonds between interest dates. Okay, we got a couple things on this one, but that's okay. On February 1st of 2015, we purchased 50,000 9% bonds at 104.5, including brokerage fees. The bonds pay interest December 31st and June 30th. Now here again, last time we paid would have been December 31st that they paid, so we're buying them 1 month after the interest period. So the easiest way of doing this first is to calculate the interest earned. Okay, now it's a debit because they're actually you're paying it ahead of time, because you have to pay them 1 month's worth of interest. So equal round, and you purchased $50,000 worth of bonds times 0.09 divided by 12, and then comma 2, or $375. The investment you have is equal to the 50,000 times 1.045, or 52,250. Okay, the investment is simply the 50,000 times this. Think of this as a percentage, 104.5. So that's the $52,250. Interest earned is the 50,000 times 9% divided by 12. So the cash that you had to pay would be these two added together, or 52,625. Okay. Now, 630 is the interest that they pay. We're not going to worry about these tables right now. We'll say, okay, so the interest that you have, this is the cash, will be equal to the 50,000 times 0.09 divided by 2, or 2250. Okay, now you'd actually be a little more complicated than that, because you'd have to go through those amortization tables and all kinds of neat stuff. But that's the interest that's the cash that you receive for it. Okay, it's the 50,000 times 4.5%, because remember it's paid semi-annually. So so that's the interest that you'd receive. So that's, and you notice, even though you bought it between interest periods, you don't worry about how much you have. So the actual interest received, what you report on the income statement would be the 2250 minus the 375. That would be the amount that you would actually report. So if you wanted to see how much interest you report on an interest statement, you take 2250 minus the 375 is 1875 is how much interest earned you would actually have on the income statement. The other way you can do this, which is less common, instead of interest earned here, you'd have interest receivable. And then you'd have interest earned for 1875 and interest receivable for 375. But that's not as common as doing it this way. So that's the two methods for those. And the next video is going to be we're actually getting away from the bonds and going into trading securities, the different cost method for the different types of entries that we have, securities.